Good morning, everyone, and welcome to NYSE TV Live. I'm Kristen Scholler here in studio at the Stock Exchange. We are awaiting the stock market open after a wave of news overnight. The Federal Reserve kept interest rates unchanged on Wednesday afternoon. It was all but certain heading into the decision, as Intercontinental Exchange's Harvey Flax told me yesterday. Well, the pause is a reflection of sticky inflation and a robust economy, as the central bank noted. Let's take a look at what's on tap in today's show. As we parse through the details of that Fed decision, senior market strategist at the New York Stock Exchange, Michael Ranking, will join me shortly to explain what it means to viewers and where we go from here. Plus, mega cap technology names reported earnings after the close yesterday. Ray Wong will share takeaways from Microsoft, Tesla, and Meta results. Their reports precede earnings from Apple tonight. And as we continue our coverage of stories of hope surrounding the Los Angeles wildfires, we'll tell you about an event of music and solidarity taking place in Southern California this evening. Well, as promised, for more on the Fed's decision yesterday to keep rates unchanged, joining me now is Michael Ranking. He's senior market strategist for the New York Stock Exchange. Michael, it's great to have you, especially after major moments like these. Yes,
it's good to be with you. It's been like drinking through a fire hose this morning in terms of economic data, central bank rate decisions, and just the amount of earnings that are flowing in.
Yes, indeed. So let's start actually with some of the economic data. We'll get to the Fed decision, of course, yesterday, but GDP coming in 2.3%. What does that mean?
Yeah, so a little bit below expectations, but still a very solid number. It is showing some moderation from the previous quarter, right? And we also saw the prices component come in, a little bit below expectations, but that did tick up from the previous quarter. The backdrop remains very solid, but the consumer spending number was also very strong. It was up 4.2% from 3.7% in Q3, right? So that continues to, kind of the overarching economic backdrop, kind of solid but moderating.
And how does the Fed decision factor into this, specifically what we heard from the Fed chair yesterday?
Yes. So yesterday's meeting was widely as expected, right? The Federal Reserve left rates unchanged, for the first time in 3 meetings, right? So we just came off of 3 consecutive cuts of 100 basis points in total. Chair Powell had suggested during the December meeting that we would be on hold, right? And he reiterated that yesterday. I'd say much of his messaging was in line with what we previously heard. He continues to show that he has a bias for further easing, but in order for that to happen, we're going to need to see the inflation data start to cooperate, or on the negative side, you would need to see kind of a real weakening in the labor market, which nobody's really rooting for at this point.
It is interesting, though, because the last inflation read that we had, both for consumer and producer prices, they were pretty much in line with expectations, not above or a surprise for that matter.
Right, yeah, and you're exactly right. And I think what the Federal Reserve is telling you is that they are confident in where kind of their policy rates currently are. And he said it multiple times, we're in no hurry. He suggested they're in kind of a wait and see mode, waiting to see what Washington policy looks like, how that's going to impact the economic backdrop, right? And in order for them to really feel like they need to move further, they need to see some further progress, kind of in the inflation data.
So to that end, we will get another inflation read on Friday, tomorrow, and that is the Fed's preferred inflation gauge. Is there anything in particular that our viewers should be watching for in that report?
So I think, given the fact that we've already seen CPI and PPI that do feed into PCE, the markets are a little bit desensitized because you can kind of back into what those numbers look like. So there shouldn't be any real major surprises, right? There is an expectation that we could see the number come in slightly below expectations, but I think just from what we've heard from Chair Powell, right, I don't think that number is going to really move the needle.
Corporate earnings also a factor, moving markets, mega cap technology names, the most richly valued companies out there, of course, reporting last night. We'll get Apple after the close tonight. What are the takeaways from these results so far?
Yeah, so I mean, the world got turned upside down coming out of kind of last week's kind of DeepSeek announcement that created a lot of volatility kind of heading into the kind of the tech earnings that we heard last night. In terms of the messaging from kind of the major CEOs, It was very similar to what we've heard. Doesn't sound like anybody is changing their any of their capex plans, right? We just heard last week the Stargate announcement. Meta did update their capex spending numbers, kind of just last week, so you wouldn't expect to hear anything, kind of yesterday. They're still very positive in terms of kind of the AI backdrop, right? And they've talked about the idea that if you start to see further efficiency and within these kind of AI models, right, that's just going to drive further adoption, and it's kind of generally a positive thing.
How does the market look to you at these levels?
So we've really been in this kind of trading range, like really since the election, right? So interestingly, I kind of noted this morning that despite all of this volatility that we're seeing, right, that yesterday the S&P 500 closed 10 points lower than where we were right before the previous Fed meeting, which did kick off a bout of volatility, right? So we're in this 300-point range in the S&P 500, 5,800 to 6,100. We're kind of in the upper third of that, currently, and it does seem like we're in this consolidation phase, waiting for some more certainty. I think, kind of coming out of Washington, coming out of the policy, and I think the earnings backdrop, kind of going back to that, as you just pointed out, I think what we're seeing this quarter is the numbers are solid. Some of the guidance is a little bit weak, especially kind of looking in kind of the industrial space. But what that does, something that we had pointed out in our earnings preview, is that what that does is potentially you're going to set markets up, for kind of a positive earnings revision cycle as we move through the back half of the year.
Interesting. I do want to ask you, Michael, of course, about the news earlier this week in regards to DeepSeek. We had seen a knee-jerk reaction. Some of that seems to be smoothed through a little bit. Markets seemingly a little bit more stable these past few days, but what's the best way to interpret that?
Yeah, so I mean, there's still a lot of skepticism, right, and kind of around kind of what came out of the DeepSeek kind of model and what kind of the inputs were and how they kind of drove those gains. What it did is really, from a market perspective, highlight just how much concentration risk and kind of crowded positioning that we're seeing in kind of a lot in this like AI theme, right? And right, so it's just caused a little bit of a rethink, right? And markets, traders, and kind of the industry as a whole, right, are trying to understand kind of what is happening here, right? And it's going to take a little bit of time for that to kind of play out. I don't think it necessarily kind of turns kind of this kind of turns things on upside down, right? But it is kind of just putting a little bit more of kind of a microscope on some of this capex spending that we've been seeing, and just kind of companies are going to kind of need to continue to just talk about what that spending, how that spending is going to ultimately kind of drive the business going forward.
Michael Ranking, Senior Market Strategist for the New York Stock Exchange. Michael's going to rejoin us, of course, just after the market open. Thank you.
Perfect. Sounds good.
All right, well, stay with us because up next we'll take a closer look at yesterday's tech results and set the scene for Apple this afternoon. That's next.
So Brightwave is an investment research platform that uses artificial intelligence to help asset managers understand more about the markets than is humanly possible.
And what would you say that makes you unique, though, from others who are currently on the market?
A number of things. So we have an incredible engineering team. So for myself, I established and led the language model engineering practice at Databricks. Created the first language model to demonstrate that open source technologies could exhibit the kinds of behaviors we've come to expect from ChatGPT. My co-founder is the former CTO of a federally regulated derivatives exchange and clearinghouse. It is.
Yeah, it's really amazing.
And his first deep learning patent was filed in 2018. We've got engineers from Meta and Instagram, award-winning research engineers, commercial team from UBS and McKinsey and Goldman Sachs. It's a stacked bench,
Yes.
and it has allowed us to execute on very, very difficult technical problems. If you think about the number of factors that are relevant to an investment decision, it exceeds the limits of a person's ability to keep it in mind simultaneously. And we see an opportunity with language models to create a technology that allows a person to connect the dots across millions of documents and see a story that nobody else has noticed in order to identify a mispriced asset.
And you decided to come to Money 2020 this year because you had a major announcement about your Series A funding.
That's right.
Yeah.
We have announced a $15 million Series A, preempted by Decibel Partners, one of our seed stage investors, and including participation from Omers Ventures. We're extremely excited about this. This brings our total funding in the past 17 months to $21 million. We've quadrupled our revenue since our Series Seed announcement in June or July, forget exactly when. And it's happened quickly. We've seen vigorous traction, brisk demand from across financial services.
Welcome back to NYSE TV Live, everyone. I'm Kristen Schuller here in studio at the Stock Exchange. After mega cap technology companies reported mixed results late yesterday, Apple earnings are on tap this afternoon. Joining me now with more is Ray Wong. He's founder, chair, and principal analyst at Constellation Research. Ray, it's great to see you. Hello on this Thursday morning. And let's start with Meta. That stock seems to be getting the best reception in the wake of its results last night. What should our viewers know?
I think the important thing is the exponential efficiency that Mark Zuckerberg talked about way back is happening. They are cutting costs like crazy. They're using AI internally to actually generate their code. And more importantly, they're sitting on the open source AI revolution because Llama is basically an open source AI that lots of people are building on top of. They've got the data, they've got the AI capability, and more importantly, they've got the social network. And those things are important, especially when you're trying to compete in AI. The other piece is important is he hasn't given up on the reality glasses. We were out in Davos and you'd seen them everywhere. That's one of the big things they're talking about. He's intent on getting the virtual reality and the reality labs piece of the business out there. And so there's a lot at Meta, a lot is on fire. The ad business is solid. The only companies they have to worry about on ads are Amazon, Google, and in some cases, we're going to see a company like Walmart emerge in that ad business, and you're going to see that coming out just like the way Amazon ads took the market on fire. But overall, I mean, Zuck plans to keep on investing in AI, and more importantly, they're going to be one of the players.
Is Meta the leader in this space? We look at the reactions this morning. Again, we'll get to Microsoft and Tesla, which also reported results last night and are part of the Magnificent Seven. Among guests that I've been speaking to recently, Ray, on the show, they seem as if Meta is the rock solid tech company out there right now.
Oh, Meta is definitely one of the leaders in AI, and I think that's not going to be, people are not going to forget that. It's not just the hyperscalers like an Amazon, Google, and Microsoft. It's companies that are putting AI to use, and Meta is going to be one of the ones that's going to be able to take that to use into consumer hands much more quickly than anything else. But we're going to see AI coming all different directions. It's not about the players that are actually building the AI. It's the players that are actually going to take AI and embrace it into their business models.
So to that end, let's turn to Microsoft because that stock was down a few percentage points, in fact, in the wake of their results last night. What is your takeaway from Microsoft?
I think the important thing to remember at Microsoft is they have one of the best sales executives in the world. Judson Hoff is basically the best enterprise salesperson, and because of that, they sometimes outsell their capacity. So what they're showing is $13 billion in AI revenues, and that's huge compared to what everybody else is doing, but they need more CapEx to deliver what's into their data centers. They've got to modernize their data centers. You have situations, for example, where you have Oracle is their provider to handle Bing searches, right? It's not happening on Azure because they're out of capacity. So it's a good thing. They're going to be one of the winners in the AI age, but the challenge for them is to get that CapEx spending up so that they can actually compete and take the capacity that they're selling. The other big piece of what they have at the moment is the fact that they have lowered their average age of user, especially coming from GitHub, coming from other areas. They are now seen as one of the leaders, especially in terms of getting to younger users and getting to the younger demographic across the board. And so they've done a great job doing that.
Ray, I also want to ask about Tesla because even though Elon Musk has certainly been solidified as a key ally for Trump in this new administration, and we saw that on display at the inauguration just a little over a week ago, we do know that Tesla didn't fare up to expectations in this latest quarter. Why is that?
So the challenge is the fact the vehicle business is slowing, right? And if you think about what Tesla is able to do, their big competition is Chinese EVs in the long run. There's no competition on the West because they can't get to the margins. And when the subsidies go away, there's no way they can play. So the tariffs are going to be the only way to help them until they get production costs lower. China will be able to compete in a way nobody will believe because they can get to 0 cents per kilowatt hour on power, and they've got the economies of scale on robotic manufacturing. And we're going to see more and more of that. Tesla is one of the few companies in the US and on the West that can actually deliver on robotic manufacturing, being able to take anything from their Optimus robots down to the completely automated manufacturing lines. That's what we're going to need to be able to win in manufacturing for the US. Now, the bright side of the business is the energy business. I love the Megapack business. If you watch that carefully, that part of the business grew almost 119%, and that's really what you want to look, 113%. What you want to look at is the fact that we're going to need a lot of energy storage if we're going to play this game. It's an all-in energy strategy going forward, and the AI race is about lots of data, lots of chips, but a lot of energy. And that's what you're going to have to play with.
And Ray, of course, Apple earnings on deck this afternoon. It too has its hands in artificial intelligence. What do you want to hear from Tim Cook?
I think what people want to understand from Tim Cook is that Apple Intelligence is helping sales. It's keeping users there. It's leading to growth in terms of the iPhone market. And of course, how many more iPhones can you sell? That's the challenge. Is it driving services revenues? That's where the highlight is. And the other piece is what we're going to see and hopefully see is that the China market has stabilized. Has it gone up? Are they gaining traction in China? And of course, and India, which is their other large market. Winning in China and winning in India is really the key to Apple's growth in terms of handsets. Winning services business with Apple Intelligence is their future growth. And of course, what are they going to do next? What are they doing in terms of healthcare? How they're entering those markets? That's what people are looking for.
Do you think that the U.S. is ahead of the game when it comes to artificial intelligence?
We are definitely ahead in artificial intelligence. In this AI arms race, what we realized is that we were so susceptible to a psyops operation by China, but those announcements saying we can do X at whatever cost, well, they used a lot of the stuff that the US created to get there. The point we have to worry about is that AI's gotten more expensive. In the internet era, things were decentralized, they were open, there were lots of players, and prices came down. The problem here in the AI era, it is centralized, it is closed, there are a few players, and it is too expensive. And it's a good thing that showed up this week in terms of what we saw from DeepSeek, because we know we can deliver better. We can do it faster, better, and cheaper.
Ray Wang, founder, chair, and principal analyst at Constellation Research. Ray, thank you so much for joining.
Hey, thanks for having me.
All right, well, stay with us because up next, we'll take a closer look at what trends will drive the commercial real estate industry this year.
So, Colleen, you joined Planet Fitness as CEO in June. So tell me about your first 6 months.
It's been a very fast first 6 months. I really leaned into spending time in our clubs and getting to know our franchisees, talking with our club team members and seeing how our members utilize our clubs. I call it feet on the street. It's been really insightful. And we've also worked on our strategic imperatives and kind of codified our roadmap for our growth ambition.
So tell me about your growth strategy and vision for the future of Planet Fitness.
Our 4 strategic imperatives really start with refining our brand promise and then making sure we pull that through in our marketing messaging. We're also leaning into member experience to make sure that we're connecting with our membership and enhancing our relationship with our members and delivering a format both inside and outside the clubs that's most meaningful for them and is going to enable them to accomplish their fitness goals. And then we lean in on format optimization and our equipment mix. And that's making sure that we've got the right mix of equipment for how our members want to utilize our clubs today. And when we get all of that right, and we're thoughtful about unit economics and build cost for our franchisees, it enables us to turn up the afterburners on growth.
Now, how will you redefine your brand strategy and communicate it effectively?
We're growing stronger together, and we're all strong on this planet. We're seeing across generational cohorts a focus on utilization of strength in our members' workout routines and our prospective member workout routines. So as we've done consumer testing and consumer surveys, as well as how we've seen our members utilizing our clubs, we've recognized the opportunity to kind of shift our mix a bit and have a greater complement of strength in our club.
Welcome back to NYSE TV Live, everyone. I'm Kristen Schuller here in studio at the Stock Exchange. While we regularly focus on the housing market as it pertains to real estate, new data is emerging across commercial real estate as well. And for more on this, I want to send things over to my colleague, Trinity Chavez, with more. Trinity, good morning.
Hey, Kristen, good morning. That's right. Real estate is improving in 2025, but experts say that a full rebound won't come until 2026. Investors are stepping back in, cap rates are shifting, and prime properties are in high demand. So what's next for the market? Well, to break it all down, Sarah Mikevich, she is the senior real estate analyst at RSM US. Sarah, it's great to have you on the show this morning.
Great to be here. Thanks for having me.
Now, with 2025 set for improvement, but not a full recovery, what key factors will shape investor sentiment and real estate performance moving forward?
The spread between public and private valuations has narrowed significantly, which is allowing for price discovery within the marketplace, which will then spur transactions and bring much needed liquidity that's been sitting on the sidelines in the form of dry powder back to the marketplace.
And with capital ready to deploy and first movers at an advantage, where do you see the biggest opportunities now this year?
Multifamily is always going to be an opportunity because of the structural undersupply of housing in this country. Another place is last mile logistics in the industrial space. And office is also experiencing a new sector in the trophy asset component of office, which is highly amenitized and in low supply currently.
And how will moderate cap rate compression and high borrowing costs impact deal flows across the real estate sectors nationwide?
It's going to make real estate investors far more intentional, and they need to be really ready when they get into an investment. They have to understand the location, the supply and demand dynamics within a marketplace to ensure that they make the right deal within that market. And there's also the opportunity to join other parts of the capital stack and in the way of preferred equity or mezzanine positions, which is another entrance into real estate investments.
And I do want to get your take when it comes to financing conditions. How will those certain conditions and demographic shifts influence multifamily demand amid Sun Belt oversupply and affordability challenges?
Affordability challenges within the Sun Belt will continue to be a challenge for the next 2 years as the supply that's come online there continues to work through the market. But the long-term shift in demographics in that sector is expected to burn off in 2026 and improve and will moderately compress cap rates as that supply moves through the marketplace.
And it looks like major offices and multifamily loans are maturing in 2025. But how will lenders and borrowers adapt to this shift? Will we see more creative capital solutions?
Absolutely. I think lenders and borrowers learned their lesson in the great financial crisis and have learned, and actually in the pandemic downturn as well, where they've really learned to communicate with each other and work together to determine the best path forward in terms of financing for real estate investments.
And prime offices remain in high demand while lower tier spaces are struggling a bit. So what's the future hold for repositioning or underperforming office properties from your vantage point?
Right now, there's going to be an opportunity within that obsolete component of the office real estate market. That is when you have transaction prices that are far below the last transacted price. There's actually been a flurry of activity in the beginning of the year. A lower basis really gives real estate investors the opportunity to be flexible in their path forward, whether they want to pursue demolition or a conversion or significant improvements to the properties to attract higher credit tenants.
But we've also seen that shift, especially post-COVID, as so many businesses are now working on remote models, right? So talk to me about how that has impacted the broader real estate sector.
It's certainly impacted the way that offices are comprised, how you attract tenants. The spaces need to be far more flexible for collaboration on the days that people are in the office, but they also need to allow for deep work and concentrated work, and that will be especially important as these back to work mandates continue to unfold.
Now we have about 60 seconds left here. I do want to get your take, though, on how are advancements like AI and smart infrastructure shaping demand for industrial and commercial properties, specifically in high growth markets.
Data centers are in high demand right now, but that's a very specialized space, and investors in that space need to really understand the holistic investment thesis within the data center component. However, there's secondary effects within the industrial sector. If there's AI embedded within an industrial property, that is likely to be in high demand. But investors with those types of properties really need to understand if they have the right access to power, especially flexible power sources within the communities that they choose to invest in.
Well, thank you so much, Sarah. That was a lot of important information, a lot of key takeaways. It was a pleasure having you on the show. Again, Sarah McKevitt, Real Estate Senior Analyst at RSM US.
Thanks for having me.
Now, don't go anywhere. We have a lot more to get to, including the opening bell, so stay tuned. That's up next.
How has this partnership propelled Snowflake's growth and deepened its ties to the broader financial and technology communities?
Well, you know this. The New York Stock Exchange is the most storied stock exchange ever on the planet, and we're thrilled and honored to be on it. But there's also a very deep collaboration between the firms. It's at the level of us being the data platform for ICE and for the New York Stock Exchange, and being an important distribution mechanism for all of the amazing data that the NYSE wants to share with its customers and partners. We get a lot of great feedback about where Snowflake should evolve from Lynn and her team. And things like the tree lighting and the judging or the icing on the cake that demonstrate how closely the companies work with each other to partner, but just as importantly, create success for all of our giant customers. It's a deep partnership that I'm very, very grateful for. I tell people that AI is already magical because these language models can do things like understand fluid language, like the language you and I are speaking, and make sense of it, extract context from it, and do that effortlessly. We knew that how people are going to consume information was going to be changed forever. Just like, back when the first smartphones came, most people in the world kind of simultaneously realized that there was a before and an after, that everybody was going to have these amazing devices with them. I think we're going to think about AI the same.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Well, in just a moment, Latin Finance, which covers banking and capital markets across the LATAM region, will celebrate the opening bell. And I want to bring in my colleague, Trinity Chavez, with more on what people should know about. Trinity.
Hey, Kristen. So today the exchange is celebrating Latin America's top capital markets leaders with Latin Finance's Deals of the Year of 2024. To mark the occasion, CEO Tamer Ahmad is ringing the opening bell, opening up the U.S. equity markets. But again, today's celebration, it's all a part of Latin Finance's Capital Markets Summit happening right here at the exchange on the corner of Wall and Broad Street in New York ahead of tonight's awards. Now, the event brings together key executives from NYSE-listed companies like BBB Foods, Telecom Argentina, and Petrobras, along with top government officials from the region. With 95 Latin American companies listed here at the NYSE, this is a key component to recognize the region's market impact. And later on in today's show, I'm going to sit down with the CEO, Tamer Ahmad, to discuss what he's hoping to get out of today's festivities. But, we have an action-packed show today, Kristen. What should we expect when we see the markets open?
Trinity, that's exactly right. So looks like a bit of a pause that we'll see at the market open, but it does come as the S&P 500 remains right near a record high. Same is the case for cryptocurrency. There is a live look at that opening bell podium. Of course, earnings, the Fed, and data in focus. Let's take a listen as Latin finance rings the opening bell. All right, we are off to the races here at the New York Stock Exchange. Latin finance celebrating the market open, and it all comes amid a slew of news between earnings from the biggest companies out there, economic data with the GDP report out earlier, and of course the Fed decision. Well, rejoining me now, as promised, is Michael Ranking, Senior Market Strategist at the NYSE. Michael, now that we are officially open for trade,
yes,
what do these levels tell you?
Yeah, so we're recouping, yesterday's losses is pretty much where kind of the S&P looked like it was opening up. Again, we as we talked about in the last segment, right? We're in the kind of upper third of this range, right? And it continues to seem like we're in this consolidation phase.
Certainly a consolidation phase, and believe it or not, January will come to a close tomorrow. We've really covered a lot in just a short amount of time, kicking off 2025. There are some seasonal trends that historically Wall Street will follow. How have those played out this year?
Yeah, so specifically there's this January trifecta, which is followed by the Stock Traders Almanac. Right, that starts with the Santa Claus rally, which is the final 5 trading days of a calendar year and the first full 2 trading days of the new year. This year that ended up in the negative territory. Then there's the 5 full trading days. That was also in negative territory this year. And then the final of those is the January effect and how the final month of, or the first month of the year it closes. At this point, we're solidly higher for the month of January. So barring a very significant sell-off in the final 2 days, it looks like we're going to end higher. Now, typically, what kind of traders will look at those kind of the performance over those time periods as an indicator as to what the kind of the rest of the year's trading looks like. So going back, there have been 7 instances where the Santa Claus rally failed to come to broad and wall, right?
As they say.
There have been 7 instances in the past where January has ended the month higher, right? And the market's ended higher 6 of those 7 years, right? And with very, very solid returns. Last year being one of them. Last year, we also had both the Santa Claus rally and the first 5 days were down. We ended up, kind of over 20% for the year, right? So, things, kind of with how January has played out, right? Things still look, kind of pretty well set up going into the next year.
It's been a while since we've spoken, Michael. I think probably the last Fed decision, actually, at the end of 2024 in December was the last time we're together. So, of course, digesting everything that's happened in the past 24 hours, the month of January, these seasonals. What is your outlook, big picture for the year?
Yeah. So. The other seasonal that I'll just highlight is as we're heading into February, right, during election year or the year after elections, right, that Q1 time period tends to be the worst quarter of the year, right? February average returns, post 1970 are down a little over 1% in the February timeframe. So just to be aware, kind of, seasonally, that we're in a little bit of a difficult time period, and that sort of makes sense when you think about kind of where you are, because you have the inauguration, you start to have some uncertainty, kind of seep into markets as you start to see some of the new Washington policies, kind of come into place. My big, kind of one of my biggest takeaways takeaways kind of heading into the year was that there was this expectation for volatility, right, to pick up. And we've definitely kind of seen some of that kind of at the end of last year and as we've started this year. And I think there are a couple of different things that are going to drive that volatility. Washington policy being one of them. You're kind of continuing to pay attention to how the interest rate environment evolves and potential volatility around treasuries. Kind of crowded positioning. We just got a little whiff of that over the last week. Right, and then the expectation that at some juncture this year we'll have an inflation scare. There may be a growth scare. We might have actually just come off of our first inflation scare, with CPI kind of seeming to calm markets. But overall, right, I do think so. While we have volatility, that doesn't necessarily mean, right, that markets can't perform well, right? And I'm still, kind of pretty positive. I think we have a solid economic backdrop.
Yes.
Which we highlighted in kind of that first, in our first segment. We have a Federal Reserve that still seems to have a bias to want to ease policy rates. And we also have an earnings backdrop, which looks like it can accelerate.
All right, Michael Ranking, Senior Market Strategist here at the NYSE. Michael, thank you as always.
All right, thanks for having me.
All right, well, stay with us because up next, Universal Music Group and NYSE-listed Spotify hope that they're playing a winning tune after striking a new deal. We'll have those details up next.
Orbit is a space logistic company. Actually, we have been the first space logistic company in the world, a pioneer. What does it mean? Space logistics for us means taking care of customer assets in space, so satellites.
But what you're describing, it can't be easy. So talk to me more about how you go about optimizing in-orbit services while also reducing costs for your clients.
You can consider the launch vehicle, the rocket, as a bus, leaving each passenger at the terminus. Our satellite, our orbital transfer vehicle, that's the technical name, is released at the terminus together with other passenger. But our satellite has on board third-party passengers, small satellites on behalf of other companies. And if the rocket is a bus, we are Uber, taking each passenger to their respective home, which is the target orbit. They could do that on their own, which with traditional methods takes 6 to 10 months, thus wasting 1/3 on 1/4 of their operational life. We can do that in much lower time. So the result for the end user is getting to revenues earlier and extending the operational life of their asset.
There has been increasing demand when it comes to the utilization of space-based technologies. Talk to me about how D-Orbit is positioning itself from a business standpoint to keep up with the growing demand.
Besides the traditional standard services, we now see a big demand for something new, which is cloud computing in orbit. The quick, immediate need of
Welcome back to NYSE TV Live. I'm Trinity Chavez at the New York Stock Exchange. Now, big changes are coming to the music industry. Universal Music Group and Spotify just struck a major deal that can reshape how artists get paid, introduce new premium tiers, and tap into superfans willing to spend more. It's a big shift for streaming and maybe a blueprint for the future. Here to break it all down is Seth Schackner. He is Managing Director at Strat Americas. Seth, it's great to have you on the show.
Good to be here.
Now tell me about how does this Universal Spotify deal reshape the music industry's 2.0 model?
It's actually really interesting. Streaming saved this industry, and but to some degree has started to slow a little bit. And the economics have been, really, really one-sided and slanted in favor of rights holders. So I think anyone kind of in between rights holders and consumers, it's a really tough margin to make. And I think artists in general, just because of the increasing amount of content that's available on Spotify every day, are making less and less. And so there's a ton of other issues, but this deal calling it Streaming 2.0, and it's really put forward by Universal Music Group first because they're the biggest in the, in the label world and recorded music, is really an attempt to reshape all the economics around it. It's going to eliminate something that was, to put it bluntly, very obnoxious sort of term that Spotify put in place legally that really kind of squatted on songwriters who are really the very essence of the music industry. And, we'll improve that and get rid of that. And it's going to set the stage for a ton of other things like premium audio tiers and even things like fan clubs and merchandise. And at least hopefully in my view, higher pricing for streaming. So it's really the right move.
Yeah, let's drill down on those points that you just mentioned, especially with the new terms that are in place. Talk to me about the significance behind this deal specifically for artists and songwriters.
Yeah, so this new one impacts songwriters first and foremost, okay? And so I think it's fair to say that Spotify took an obnoxious legal strategy basically to classify themselves as something other than just a pure play music service. Something that might think about maybe like a Sirius that has lots of other programming, which it does, but it essentially completely reduced the payments to the songwriters. So the new one eliminates the bundle, if you will, and Universal Music's publishing company, not the label, but the publishing company that works with songwriters, Bob Dylan, lots of other things that aren't Universal artists, cut a direct deal actually with Spotify. And that's actually pretty huge. I won't go through all the details of all the music intermediaries, but it bypassed them. So songwriters should basically make more money from this. And I think there's another aspect of this that I don't think has fully come into focus yet, but it's called the artist-centric model. And it's Universal's play to kind of change up the back-end pool, if you will, so that artists get paid more. And I think that will eventually come from it as well. So it's pretty groundbreaking stuff if you're looking at how the economics work of streaming for people other than the labels or Spotify.
And when it comes to subscriptions, do you really think that they are underpriced, and how could this deal lead to broader industry-wide pricing changes?
I do, for sure. I mean, you get everything under the sun from Tchaikovsky to Miles Davis and heavy metal for, $14. So if you just look at, out in the landscape at Netflix and what they've done, they, raise prices typically each year, and they don't even lose subscribers from it. So, I mean, to me, 100%, it should be more. What's happened in Music Trinity is that artists now have a lot more independence than they used to. So this is also something where, if you think about if you're a super fan, I don't know, of Oasis or Olivia Rodrigo, you might want to buy a t-shirt. You might pay extra to see one of the artists do something special for you. And if you think about the old school notion of really old music fan clubs, this is something digital that is super cool, that can be higher priced, that the money might go, most of it would go directly to the artist. So it's got a lot of stuff in there that can kind of change the way audiences interact with music, and it won't just be about sitting back and streaming anymore.
And will this deal become sort of the template for other major labels and streaming platforms? And how do you think this will impact the future of streaming negotiations?
Yeah. Look, I was on the front lines of this for Sony for 11 years for Jive Records and Sony Latin. And, part of that was being an independent or smaller labels, even inside Sony. And, strategically, you're always going to wait for kind of someone else to land on the beach first, if you will, and establish all the terms and build structures by which all of your label can kind of pass through. And that's called, legally, it's called setting a precedent. And so that's essentially what's happening here in my view. The biggest one of the big three labels is setting a huge precedent. So yeah, I believe it will happen throughout the industry. It might ripple through in different ways, but for sure, I mean, I think Universal's setting out a benchmark for it, and I think others will follow.
Well, thank you so much for joining us on the show this morning. Seth Schachner, Managing Director of Strat Americas.
Great to be here.
Now, from music to gaming, Mother of Games is shaking things up with its debut title, Lazoo. Think live action meets surreal animation in a mind-bending, interactive experience. But what's the real game changer? Womb, Mother's proprietary AI that tailors the story to each player. I recently sat down with the CEO and co-founder, Kelsey Felter, to learn more.
think part of why we started the game is to help you play the game of life. And in the times that we have today, where it's a wild and crazy reality, the planet that we live on, the reason that we did live action and animated experience within the trailer was really to show that the skills you acquire in the game can be taken outside of the game, and you can bring them to life in your daily life.
And talk to me more about how Lazoo encourages serotonin and for the players who are utilizing the platform.
We've really created a gifting economy, and the idea that you can have an exchange with another player without it having to be dopamine driven or obsession driven or addiction driven. And a lot of the minigame experiences kind of focus on creating that connection of opening, which allows for that serotonin or love hormone to kind of come through. And that's actually a hormone that allows your mind to expand as well.
And, you know, talk to me about how the AI-driven platform Womb is different from everything else that we currently see in this sector.
Sure. So in Womb, we have something called DOTS, and DOTS is basically a data transform system that allows models to talk to other models. So we believe that models are going to become commodified, and it's really about how do you help one model talk to another model, or how do you help a human talk to a model in its native language. And Womb creates that through DOTS, which is our emergent gameplay model that is embedded within Lazoo.
Really shaping a whole personalized experience. Would you say that that's what makes you unique?
I think so. Emergent game mechanics have been really difficult to crack, but with the advent of AI, it allows us to create a generative experience that is not only personalized, but also you can share your personalized experience with friends within the game. So something that you might see, you could actually bring me along for the ride, and I can see things through your eyes, for example, in the game itself.
Wow, that's incredible. Tell me about how do player choices create different storylines in Lazoo?
So when a player makes an action, it gets coded into what is called a vector format, and that gets given to an AI layer. And that is kind of the way in which your actions can create results, and the characters that you interact with start to behave and adapt differently to you based off of the actions that are being fed to it.
And you recently just had a $5 million fundraise. Talk to me about how you utilized this fundraise to really push AI-driven game design.
So we used it to tackle problems that we were facing. We didn't just decide to sprinkle AI onto the game. We used the game storyline as the root and basically said the AI needs to be in service of the game lore and the game mechanics, not simply an AI game, but actually an AI is serving the purpose of the game.
What has been the feedback from game testers?
Well, it's funny because I think that we were not expecting that people would feel that it's such a deeply relaxing as well as enjoyable experience. But the number one piece of feedback that we got so far is players love to use the game as a decompression tool at the end of the day, where they just want to have like a wild, expansive experience, especially after a day where they're having to perform, you know, create work product, etc., and they just want to decompress.
Yeah, absolutely. But tell me more about the inspiration behind creating such a surreal world and aesthetic. Was it designed thinking about that concept for your users, you know, as a place to get away from the reality and the monotony of everyday life?
Yes, I think what we're seeing with the advent of generative AI image tools is that hyperrealism is getting tapped out. We're considering, you know, something that is allowing you to ask the question, what do I think it is? How am I experiencing this reality? Not instead, is this real? Am I seeing something real? No. Instead, can I go to a fantasy place? Can I explore my own mind? And can I enjoy a surrealistic reality? Because right now, everything around us looks hyper real. And there's an opportunity right now in the gaming world to define a new art style that is not simply replicating life on Earth as we know it.
How do you see Womb shaping the future of the gaming industry?
So I think that many gaming companies are legacy gaming companies. They're struggling to resurge legacy IP. And I think that where things are moving, there's not really a front runner right now in AI native gaming. And that's really where we sit, is that we're one of the new kids on the block. We're creating AI native gaming, very similar to what Pixar did when they created their own animation pipeline using their own technology. They used their technology in service of the story, in service of the entertainment, and that's really what we're doing as well.
Now we're going to take a quick break, but right after the break, we're going to speak with today's bell ringer as well as cast a spotlight on a benefit concert that's taking place in LA tonight. So stick around.
So you work with many organizations undergoing digital transformation. What role does observability play, and where does Dynatrace fit in?
When you're going through a digital transformation, most likely you're going to change a lot of your digital estates. You're building new applications, you're connecting maybe a new mobile app or a new service to your backend systems, connected to your AI system. So the first thing you need to do where observability helps you is really understand your entire IT estate. What are you running? Which components or which applications are talking to others, what's working, what's not working, because you're obviously going through this change, you're going to iterate over this environment and keep evolving it. That's one role that observability is playing. And once those services are then live and users are using it, observability helps you to optimize the user experience. I think just 2 days ago, when there was the British Airways outage, how do you feel at an airport if the service is not great? So observability does both. It actually helps you to understand how your system is working and how the individual pieces play together. And it also helps you to understand how users feel about your service, whether it's working for them. And then finally, if something goes wrong, and every now and then obviously something does actually go wrong, it helps you to find the issue quite quickly and helps you to also to resolve the root cause, or what the actual problem might be. Because as you can imagine in complex landscapes, there's thousands, even millions of components. And observability and Dynatrace also helps you to pinpoint exactly where the problem is.
Now, Dynatrace has been working with AI for more than a decade. As the discussion regarding the cost of generative AI investments and ROI heats up, tell me, how is Dynatrace helping organizations to get the most value out of AI?
So we have a dedicated solution that we call AI observability. So we just talked about observability. Now we're extending it just to the realm of AI, so helping understand how much.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler, and a quick look at the markets does show us fractional gains across the board. The Dow up 126 points, 0.3% as investors continue to digest earnings. Well, earlier this hour, Latin Finance rang the opening bell to kick off the session, and my colleague Trinity Chavez is sitting down with the company's CEO. Trinity.
Hey, Kristen, that's right. We are here with Tamir Ahmad. He is the CEO of Latin Finance right after today's opening bell. Tamer, it's great to have you with us in studio. You know, I know that we were just talking. This is your third time here opening up the U.S. equity markets. What has been your favorite moment?
Well, thank you. It's a pleasure to be here. It's a pleasure to be back. As we were saying, this is the third time lucky, they say. Third time's a charm. I'd say the whole experience from start to end really is phenomenal. The stock exchange does an incredible job taking care of all the guests from start to finish. It's a seamless experience. But just being in this room with the history surrounding you, feel it. And that really is striking.
But what does this tradition mean for the region's growing, for its growth, and what it says for the future of this growing tradition?
Well, I think one of the reasons we're here is to celebrate Latin Finance's Deals of the Year awards. Now, Latin Finance is a financial media company. We cover the markets of the region for the past 35, 36 years. Mm-hmm. The Deals of the Year recognize excellence in the capital markets.
Yeah.
So, being here for the third year, we're bringing some of Latin America's top issuers to New York, to the exchange, to showcase their work. And I think the more we can do that, I think the more attention we can bring to the incredible stories from corporate Latin America.
Really highlighting the region's growing market presence here, and you're doing that at the exchange. What key trends would you say are shaping Latin America's capital market? What shaped them in 2024? What are shaping them in 2025?
Well, I think a lot of the last few years was coming back from the pandemic, and people finding their footing, economies finding their footing. But I think we've seen corporate Latin America has been consistently on an upward trajectory. We've seen some kind of softness in the equity markets, less IPOs than perhaps we would have liked, but we think that trend is turning now. Our expectation is for more activity going forward.
And with 95 Latin American companies listed here at the New York Stock Exchange, how crucial is NYSE Latin finance to the broader community, especially when it talks about cross-border investment?
Right. I think absolutely. I think it's extremely important to draw attention to the opportunities for international listings and for international capital raising more generally, and I think that's really the reason we're here.
And what would you say the biggest opportunities are for this region come 2025?
I think the opportunity is to ride this wave coming out again with stabilizing economies. We have growth in the region, a disinflationary trend in the world, which I think is supportive for a lot of these economies. There are a lot of challenges. Of course, they're going to have to navigate the environment carefully, but I think by and large, we're seeing a very positive momentum going into the new year.
What are your key priorities for the rest of the year? And I say the rest of the year just started, but
right, the year just started, but I think already just in the past 3 weeks, it's been a whirlwind. I think our priorities as a business are certainly to keep engaging the LATAM issuer community in the way that we do through our news and bringing the best stories that we can to the public, which is our job, and hopefully coming back here next year to celebrate the next crop of winners.
And sharing those stories with us.
Indeed.
Absolutely. It was a pleasure having you.
Likewise.
Thank you again, Tamer Ahmad, CEO of Latin Finance.
Thank you.
Now, before we go, I do want to send things back over to Kristen, who is following a significant event taking place in Los Angeles tonight. Kristen?
Trinity, that's exactly right. As we continue to highlight stories of support, there is an update that we want to share. Tonight in Los Angeles, musicians will come together in solidarity for those impacted by the recent wildfires. The fire benefit concert taking place at the Intel Dome and Kia Forum is dedicated to rebuilding beloved communities. Donations will go towards shorter-term relief efforts and longer-term initiatives to prevent future fire disasters in the area. Well, NYSE-listed company Live Nation is the producing sponsor of tonight's event, and performing acts include well-known Southern California groups like the Red Hot Chili Peppers and No Doubt. Big names like Billie Eilish, Stevie Wonder, and Pink will also perform. So for those attending, doors open at both locations at 5 p.m. local time. The event starts at 6 p.m. at the Kia Forum and 7:30 p.m. at the Intuit Dome. And for those of us following along from afar, X will also live stream the event starting at 7 p.m. Pacific time. Of course, Trinity, our hearts continue to go out to everyone who has been impacted by the wildfires, and we continue to think of them as we try to support the rebuilding efforts there.
Absolutely, Kristen. But it's just so great to see how the community, the country really has come together, especially in these relief efforts as the West Coast, as California is working through these wildfires. And, it's something that we have been covering on our show here every single day. And our hearts continue to go out to everybody who has been impacted there on the ground.
Absolutely. As stories of support and hope are everything that we're about here at NYSE TV Live. And that's going to do it for today's show. We'll be tuning in tonight, of course, remotely. We'll also continue to cover the markets, and we'll see you back here tomorrow morning, Friday, 9 a.m. Eastern, as we send things off, stocks up fractionally higher on the day.
being innovators in the market. Thank you for all you do every day to show the world what best in class truly means.
We are incredibly proud to join the ranks of other highly successful companies who partnered with this legendary institution.
What a time to be here. I am so proud of what we're doing. This is a huge milestone for our business. There's a lot of people responsible for getting to where we are today.
We have a role to play in bridging the gaps that exist today between us.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. I'm so optimistic about what lies ahead. It has been a privilege to be with you.